Hello and welcome to Crypto Weeklies. In this video, we analyze the current composite crypto related risk for major cryptos. None of the content is financial advice. Let's start with Bitcoin and ETH. We'll spend most of the time analyzing these two cryptos. Today, Bitcoin composite risk is less than 0.3, is at around 0.28. ETH risk is at around 0.25. So together, Bitcoin and ETH are dominant. Their market share of the entire crypto asset class is close to 70%. Bitcoin, roughly speaking, 59%. Again, just rounding it upwards, and ETH, roughly speaking, 11%. So gets about 30%. For the rest of the asset class, out of which most of it is again a significant chunk of it is in stable coins, which is again. Technically, it's still crypto, but it is still pegged to assets outside of crypto asset class, such as fiat currencies. So, where do we find the current composite risk score? This is available on CryptoWeeklies homepage. So this is the one of the chart analyzing crypto Bitcoin as from a time weighted average price perspective. If we go and check Crypto Weeklies related content, the crypto composite risk model is available on the home page. You can scroll it down, and you can click on the full report over here, and it would provide it a link to the updated model. Bitcoin and ETH both in accumulation territory with that risk less than 0.3. This is updated as of today. This is my own website. You can check all of the content on that Crypto Weeklies website for free. No sign-ups required. The link is on the description. So what goes in this model? In this composite risk model, there are 7 distinct factors, 3 of which are related to trend and valuation. The logarithmic regression based deviation, how far is the price deviated from the long-term growth curve or fair value of these assets. Time weighted average price deviation, how the price is relative or extended from the time weighted average price. If it's too extended, that means risk is high. If it's undervalued with respect to the time weighted average price, the risk is low. Based on the 140-day or 220-week simple moving average, how far is the momentum extended from these levels? Together, this is almost 2/3 of the interpretation of what the price is. Then the rest 25% or 24% comes from how far is the current price drawn down from the previous all-time high. So if the drawdowns are severe, let's say for example 80% drawdown, then the risk is minimal. If the price is near all-time high, that means the risk for accumulation is maximum. Volatility, how is the current standard deviation of return with respect to historical return? That's 6%. How is the correlation of that asset with respect to the S&P 500? Higher correlation means higher risk, and risk adjusted returns or Sharpe ratio, that means this typically measures the risk score with respect to how are the excess returns on that risk adjusted return. That is these 3 are about 18%. This is about 25%, and the 60% is roughly speaking 60% is the trend and valuation. So these assets, so for example Bitcoin, let's take Bitcoin or ETH as an example. Bitcoin with respect to that time weighted average price risk is elevated, risk level 7. There is a difference of about 141% between the price and the time weighted average price. For context, again, the price does not go lower than the time weighted average price at the bottom. It typically is in risk level 3 or risk level 2. Personally speaking, whenever the price is in the risk level 4, or even one could make a case for whenever the risk levels are in risk level 5, that makes some sense to DCA, because there is no guarantee that the price action has to go to the lowest risk level. So for example, if you were waiting for the price to go to risk level 1, you would have essentially missed out on all of the bear markets starting 2018, 2019. Risk level 2, you would have missed the 2022 bear market. Risk level 3, you would have barely got some BTC at the bottom. Typically, risk level 4 is more reliable, that in the bear market price action would have a chance of going down to the risk level 4 has not happened yet. Risk level 5 is again not the worst time to DCA this. If the threshold is again risk level 5, you not only you would get a chance, again not financial advice, not only would you get a chance to accumulate in the bear market years, but also in the major counter trend downturns in the midst of a bull run. So for example, over here in 2023, as well as in again twice in 2023 or thrice in 2023, first entire quarter in 2023, then again the June drop in 2023, and then again in September. So the risk level 5 is definitely again provides much more wiggle room than these lower risk level. That means that instead of accumulating BTC at $15,000 at in a lump sum fashion, again if there is a DC or dollar cost average with systemic or ladder down approach, when and if the risk level goes sub risk level 5, essentially accumulating at a decent zone. Again, I wouldn't say the lows of 15,000, but again the price at that point was at 22,000, and again in terms of the delta or a drop from that point was less than 45% towards the macro bottom. Even over here the price was 25,000, but again with the historical evidence that Bitcoin had dropped at around $15,000. Similarly, the risk level in 5 and below in 2018 was at around, roughly speaking, at around $4,500. From that point, Bitcoin did rally to that 70k, roughly speaking, that 13x from here. From that, an average of over 25,000 over here, price rallied about 6x from 25,000 to 125,000 in 2025. What we wait for over here is again not financial advice. A price to come to this blue line, which is the time weighted average price, understood better in terms of the gravity of time. That means identify not just what the current price is doing or current price action, but this analysis considers where the asset, that is Bitcoin, has spent its entire lifetime. If the price is close to the time weighted average price, with Bitcoin you're essentially beating the clock, entering at level where market has spent very less time in. As the risk on the time weighted average price model goes lower and lower, then at that point accumulation makes most amount of sense. The opposite of this is again in the bullish seasonality, let's say risk level 7 and above. We are currently in risk level 7. In the bullish years, keeping the ear to the ground whenever the risk level goes to 7 and above, especially level 8 and 9. That's where the peak for Bitcoin occurred last time around. In that time period, again the last time risk level 10 was achieved in 2021, not in 2025. Risk level 10 was not achieved over here, but risk level 9 was. Maybe next time risk level 8 might be more realistic, but definitely in any time when the risk level is in risk level 9, in the next potential bull run of 2028-2029, this model can help identify if the top or if the price action is overextended. Again, not actually predicting the top or determining the top, but again providing a range for distribution. Again, not selling at the top. Selling at the top is very hard, just like selling at the or buying at the eventual bottom. Again, there is no perfect top prediction or bottom prediction. This is just a directionality based analysis. This one model, when used again with other similar models which go into that overall composite risk analysis, such as for example over here the diminished decay-based model, to identify where the price of Bitcoin is with respect to the historical lows. Again, this is accounting for the diminishing volatility to the upside and to the downside. Right now the price is lower than the fair value estimated from its regression based life cycle based regression based fair value or growth curve, as you would like to call it. This is a non-linear model with 2 degrees of freedom, the polynomial regression model. This model helps identify where the accumulation zone for BTC kind of starts. Again, this this light green line says that right now price below 59k, if it goes below 59k, that could usher an initial accumulation phase but in the bear market drops, in the later half of the bear market drop, there is likely that the green line, the dark green line could come into play, which is currently at around 44,500, but it's a growing function. So it could well be closer to 50k by the time the price hits or gets close to it. Right now the price is in a counter trend rally. Bitcoin is in a counter trend rally at the price at around 68k. That is again closer to that 2021 high. Let's say if this holds as support and then there is one more counter trend rally, per our estimation of these momentum candles, taking a cue from the last bear market, March of last bear market, essentially the candle body was very narrow and it was essentially a wick to the upside and to the downside. If that kind of happens this time, the width has to go to this level, somewhere close to 80k. So that's the prediction for March. Again, not too deterministic on that prediction, but that's again just taking a cue from the last bear market. That could again take away the accumulation phase and push it forward sometime in, let's say, late May, early June of 2022. If you were to take the last bear market as an example, the drop below the green line over here, the meaningful drop below this green line came in later half of June 2022. Again, this is the drop mid June of 2022. That's when the price action dropped below the green line over here. So that still is ways ahead of us. At this level, the price has found some support. Let's see how far the support comes into the play before the eventual bear market drops. So with that, I would like to conclude by saying, again, this time around, again, with respect to these composite risk models, you can do the same analysis for ETH as well. ETH, again, right now much closer to the time weighted average price. ETH eventually, again, unlike Bitcoin, spent some time below the time weighted average price in the bear market years, like it did back in 2022 and unfortunately in 2025 as well. This time around, time weighted average price has provided some support. There is only a difference of about 15% between the price and the time weighted average price. What I would imagine Bitcoin, if the Bitcoin were bottom were to be at around 55k this time around, then the price of ETH would spend about 20 to 30% lower than whatever the time weighted average price is at that point. Let's say if it gets extended from 1700 to 2000, 20% on bottom on that 2000, the price of ETH bottom could be closer to $1,600, like the current price of ETH is. But again, with that evidence that even though Bitcoin falls, ETH falls lower, because ETH has rallied much lower or much lesser than what Bitcoin rallied in 2024-2025 time period, and also came down to the time weighted average price in the midst of a bull run. So with that, I'd like to conclude. Hope you enjoyed the content. If you did, please give a like and subscribe, and check out all of these individual charts on CryptoWeeklies.com, and hope you have a nice day. Bye bye.